All right, welcome back to this 16th episode, I believe, of the Growth Factor. This one, we've kind of got a tale of four investors that we've got a number of things going on in the market right now. We had yesterday a 1,000 point run up on the Dow Jones. And that's after we've had a one. I think we're down 2,200 over the last month, and that's after a 1,000 point run up yesterday. So we were starting to see that correction that I've been expecting to see for a while, and then all of a sudden, news busts out and Trump announces that we're expecting that the war over in Iran may not last as long as what we expected, and so we have a little bit of a short, I think, run up based on that. But that being said, we've got all kinds of headlines right now in the media that are really driving the financial economy right now. So, like I said, welcome back to this 16th episode, and I've got Brian back on with me today. And so, Brian, with your experience in the financial market, kind of seeing everything that's going on, also being involved in the private markets, you've been with us for a while now. So let's start with these headlines. We've got the war headlines and volatility going on there. We've got the Magnificent Seven pulling back. There's kind of a value correction or value rotation. So when you zoom out, you look at the big picture. What is the real story that the market is telling investors right now?
Yeah, I mean, a lot of uncertainty. I think ultimately global markets are grappling with a number of different things, rising volatility. Obviously, the geopolitical tensions are causing a slowdown overall in some business activity, as we've kind of seen. There's a clear shift to value away from technology. And we see that with the Magnificent Seven. Obviously, a lot of volatility there, but essentially, as we sit today, right at the beginning of April, the S&P is actually in red territory. Let's not look at just a couple of months. Let's look overall. But as we've talked about on prior episodes, it's been with some hiccups along the way. 26 years since the last major market correction. To your point, some of the headlines today was up significantly, and that was specifically related to some news regarding the war in Iran possibly coming to an end. The Dow soared over 1,000 points. The S&P and the Nasdaq also surged today. S&P today was up about 1.5, almost 1.75%, but it's down close to 5%
I
for the year.
mean,
Again, sitting here
year to
in April.
date, year to date, what I say year to date. So January 1, we were trading somewhere between 48 and 50,000 on the Dow, right? And we're down sub 46 even after a run up today. Like we're starting to really see that correction. And we're back, if you look back over 12 months, we're halfway between where we were a year ago and at our peak back in what was that, about 3 months ago? We were at our peak at 50,000, give or take.
Yep.
And so we're seeing that looming correction going right now. And because we got some positive news on the war, yes, we see a quick run up. But still, you know, many investors are playing with house money at this point. And the smart move has to be, what are we going to do with that smart money? And are you going to leave it all in and risk, or are you going to start diversifying a little bit? And Brian, you've said, you've always said IAS. It's all about the earnings, stupid. What does that mean? What does that mean in plain English? And why does a Ford PE ratio around 22 matter for what we should expect next? What does that matter there?
Yeah, I mean, ultimately, when you look at the valuations of the market, and we're currently looking at a price earnings ratio for all the companies in the S&P at around 22. If you peel out just the high technology, high growth stocks, some of them are trading at 40 or 45 even. But slightly elevated valuations over their historic norms. And to your point, yeah, it is all earnings. News is going to have volatility. It's going to generate volatility. I mean, one little blip today regarding geopolitical tensions that can have an impact on the economy. Jerome Powell speaks at a college as he did last weekend. That's going to have an impact on the market. So that's going to be very short term volatility, but ultimately it's all around valuations and around earnings. So
So
that's a term that you hear more and more.
explain for our viewers. So, we've got 750 investors, and of those, 10% of them are very sophisticated, whether it's equities market, real estate, you name it, very sophisticated investors. A number of them, we've got a large volume of our investors that have, they've found their niche. They worked hard. They did good with their money, put it back, but they don't necessarily understand investments at a really high level. And so explain price earnings and explain why 22 is kind of that number. What is that in layman's terms for somebody that doesn't understand finance at a high level?
Yeah, so in a very simplistic, high level way to look at stock valuations, if you look at the analysts, there's a number of analysts that cover specific stocks. They're going to look at dividends, potential future dividends. They're going to look at management makeup, tenure of manager, if there's turnover and things like that. But ultimately, the number one thing that they're going to look at is what do the earnings of the company look like? That's why when you see these quarterly earnings reports coming out, so many people are focused on it, and the price of the stock is so impacted based on the earnings reports that do, for most publicly traded companies, that's going to come out on a quarterly basis. It's just a factor of what do the overall earnings of the company look like as compared to the market capitalization of the underlying stock being held by the company. And it's simply a matter to say, what should that stock value look like based on the earnings of the company? Pretty simple to think of it this way. The higher the earnings of the company, the higher the valuation of the stock. The lower the earnings of the company, typically the lower the valuation of the stock.
So if you take that into consideration, and we've kind of got, well, the Magnificent Seven um, have been valued, I think, arbitrarily, and it's not necessarily based on earnings. It's based on an expected product, and now we're not necessarily seeing the revenue from AI that we expected to see from many of those companies as quickly as we expected to see it. So how does that impact these companies? And you can go back to Uber, Facebook, a lot of these tech companies or companies that launch and they don't necessarily own a physical tangible product, but they're bringing a service to the marketplace in the form of a publicly traded company. How are we getting the valuation of those stocks?
Yeah, that's a great question. And that's where you have to look at intrinsic value versus extrinsic value of a company. So there is a factor of actual earnings and then there's expected earnings. So when you look at NVIDIA, it's a great example,
Yeah.
very tied into expected earnings, tied specifically to AI. Where do we feel like that market is going to be? And a lot of analysts will say there's a lot of room to grow as it relates to AI. Well, NVIDIA is very invested in the chips and a lot of the hardware and software that drive these AI data centers. And so that's why you see valuations not just at 20 or 25, but in some cases 40, 50, or even 60 times earnings when you factor in expected earnings as it relates to the overall stock valuation.
So you're bringing in, and you've talked about this a number of times already, volatility. And even with volatility, equities by and large have had extremely meaningful gains over the last couple of years. Now we've finally started to see a bit of a correction, but still we've seen extremely strong gains. While real estate over the last 3 years has been it's been in a tough stretch. We haven't had we haven't had assets trading. and you have operators that have access to capital that are not in a position to where, oh, we have to fire sell a product. Now, many of them, ourselves included, and many of the private equity structured real estate operators, they're feeling the impact of the market and their assets are not tradable, but because there's no buyers in the market. But there's a need for capital in the assets because of the debt markets and things like that. And so obviously with private equity, you want to move your assets and you don't want to be holding for 10 plus years. But needless to say, real estate's been in a really tough stretch. So why do investors, what gets an investor bearish on real estate right now when often opportunity is created in those tough spots? So how does an investor really get over that hump and become bearish on real estate when they're looking at the tough stretch it's had for the last couple of years and equities have been so strong?
We've talked about that before on episodes. It's simple behavioral finance. People tend to be very myopic as it relates to their investments. I talked to a number of investors just today that we were talking about overall allocations because it is easy to get discouraged, even bearish on real estate as an asset class when you've seen the equities markets perform significantly over the past several years. And why would I want to reallocate a portion of my assets that have performed well and move those to an asset that maybe has had some challenges over the past couple of years? When ironically, that is exactly what you should do is buy high or buy low, excuse me, and sell high. So it's very easy to get discouraged, but also when you kind of think about overall investing, this is where it's important to look at your overall allocations. And one good example, I'll use a technology stock for one of our investors that I spoke with. They have not changed their allocation to that at all, and it ended up being somewhere around 5% of their total holdings. Again, they didn't change anything, they didn't add any, they didn't take anything out. And when they did a review of their portfolio a week ago, that technology stock that made up about 5% of their portfolio now makes up about 20%. So one
So,
fifth of their portfolio.
well, and they're using that, and that's based on because of the strong earnings they've had in the equities market. I know you had your calendar absolutely full today. Mine was pretty full, and I talked to a potential new investor, guy out of New York, this morning. That he's a young guy, late 40s, had kind of the executive path. He's been an executive for marketing for a number of different companies, large companies, and he finally decided he's going to kind of take a step back, and focus on allocating capital and building his investment portfolio. 8-figure net worth guy, and done fairly well with investments. He he has been the beneficiary of the equities market for the past 3 years and the strong climb that it's had. Not been dumping a whole lot of money in more recently. He has been more allocating to real estate liquidity events that he's gotten. But now he's at a point to where he was like, look, I'm so heavily allocated in the equities market. He sat down with his financial advisor, and his advisor was even like, look, you're playing with double house money at this point. Like, let's reallocate. And so he sold some of his earnings only, liquidated about 1.5 million, and then left the remainder of his capital, original invested capital, plus still some earnings in the equities market, and pulled a line of credit against 50% of the remaining earnings that he had in. And so pulled another line of credit of about $1 million. So between what he sold on gains plus the line of credit that he pulled at 6% interest, he's got $2.5 million to allocate into real estate with only 6% interest against 1 million of it. I'm not giving financial advice by any means at this point. This was a unique and a strategy that some people use. But he's got $2.5 million of ultimately house money that he's deploying at this point and using a little bit of leverage to arbitrage. So now the blended cost of that capital is not 6%. It's closer to 2.75. If you apply the cost of that capital across all 2.5 million that he's deploying. And now his cash flow that he can generate, if he invests in real estate that generates 3 to 6% in cash flow, just a measly 3% to maximum 6% in cash flow. It covers the cost of his debt, if not by double. And he gets to partake in the equity that's bought at the beginning, like we always talk about, the appreciation on the asset, and the tax advantages that come with real estate. So now he's hitting on all four of those keys that I talk about oftentimes as it pertains to real estate. And so, I think that's where a lot of investors right now fall short-sighted, and they look at, oh, we had 1,000 point run up today on the Dow Jones. Let's stay focused on that. Well, yeah, you're winning. Don't be the person on the cruise at the casino that's up 5x and decide that you're going to keep gambling and you end up down 10x. It's time to take some chips off the table. And so, you mentioned that we're going to tell a story of four investors. So set the table for us a little bit. Who are the four investors, and what are the two sides of the table that they can play? And I think we're kind of talking about it right now.
Great question. So if you think about different types of investors, imagine you've got four investors sitting at a table, and on the left side of the table, you've got investors that I would say are risk averse investors. For right now, let's forget about what their ages are, but let's just say that side of the table is really a more risk averse investor. And on the right side of the table, you've got two investors that are willing to accept risk along the way. And the big question is, who is going to end up generating greater wealth at the end of the rainbow? So why don't we break that down a little further? Let's talk about the risk averse investors. Two major types. There's your typical public equities investor who are risk averse. And then, Ty, as you know, we have real estate investors that may also be a little more risk averse. So what does that public markets investor do to help protect some of the downside? Well, annuities are a great example. There's a reason why annuity sales spike when we see volatility like we've had today, especially if there's been a big downturn. Because one of the benefits, I'm not downplaying annuities, they can be a good strategy for the right investor. One of the benefits of annuities is they have a number of different provisions. There's hundreds of provisions. One of those is you can lock in a high water. So if you do see the markets go up and down and ultimately it goes down, it is going to set the value at a high watermark. Typically, that's done on an annual basis for purposes of determining what your income is going to look like ultimately when you retire. So it's a very, I'll say, popular strategy, especially for pre-retirees who are concerned more about volatility and they want to lock in, let's say, this high watermark provision for purposes of determining their overall retirement income. The other thing is that those products sometimes carry living benefits, they carry death benefits, and they protect the potential of having distributions possibly go down once you start taking those again, typically at retirement. So that's the benefit. What are the drawbacks? Well, you don't get that for free. An insurance company isn't going to give you that benefit out of the goodness of their heart. They're going to charge for it. So you are paying for the insurance. Typically, those fees can be 2% or even greater. And what you're essentially doing is shifting the risk of a market downturn from you to the provider, the insurance company, but you are going to pay a price for that. Let's also talk about the left side of the table, and that would be the real estate investor. What about
Well,
a real
before you
estate
go,
investor?
so before you go to the left side of the table,
Yep.
what, so explain to our audience exactly in third grade English, because this is something, and I've got a master's in accounting, and I don't necessarily understand the high watermark setup and what that is. So what's a high watermark step up, and
Yep.
what exactly does it promise to investors? And then also, but what does it cost an investor over time?
Yeah, really good question. So let's just use a dollar figure. Let's say you invested $100
Okay.
in a variable annuity contract, which had a high water provision. And over the course of 5 years, let's say that the value of that, it's a variable annuity, so it invests in public equity markets. Let's say the value of that rose to $120 and then it went down because of volatility to $80. Well, when you retire at the end of, let's say, 5 years, it could be longer than that, they will set your benefits base not at the $80 that it's worth today, but at the $120 that it actually rose and grew to. So that's, you think about water kind of going up and down, they're basically going to lock in your benefits base at that high water mark. And typically that's pegged on an annual basis. So it's not done every day that the market's open. They'll look at it and say, okay, on this date of the year, what was the valuation? That locks in that high watermark for that specific year, and they do it again the next year and the next year, and then at some point you retire, and that's going to lock in your base, and then the distributions that you're going to get paid on it are going to be based on that benefits base of, in my example, $120, not the $80.
And so obviously that comes with a cost because you're you're getting the benefit of the peak at every given year. So what does that cost over a period of time?
Yeah, so that's going to vary based on the number of features that you want to build into the annuity provision. Think of buying insurance. If you've recently renewed your homeowners or your car insurance, the more features you want, the more it's going to cost. And
And this
so
is going to come in the form of fees.
it's going to come in the form of fees. That's exactly right. And it's typically a percentage of invested assets. So while you have $100 in my example invested, to get kind of a general benefits base provision where they do lock in that high watermark, they're going to charge you somewhere around 2% just for that. So think of it this way: if your
You're
earnings,
going to be running on 7 or 8% in total fees on your invested $100 in your
uh,
example, by the time you're all said and done with that annuity, I'm sure.
potentially, yes, yes. The more features and the more I'll say advantages that you want to protect you on the downside, the more fees you're going to be paying. Absolutely.
So then you brought up, on the other side of the table or the more risk averse side of the table or, real estate. How do you alleviate some of the risk? And we've done this in the past. So I'm curious on your thoughts on this strategy, because we've used this strategy that I think you're going to talk about in the past, and it comes with pros and cons as well. And before we go into that, I'm going to kind of give maybe an analogy a little bit because oftentimes people, the majority of people are risk averse and not willing to necessarily ride the risks. Oftentimes it's the entrepreneurs, it's the really motivated that are willing to take some risk. And what you end up getting, it's like the Wayne Gretzky approach. If you're going to be risk averse and not take the shot, then you're guaranteed to miss the shot. But the person who takes 100 shots is going to make a shot. And so, you know, you hear all the time that the best offense is a good defense. That's for somebody that doesn't want to win. You still have to play offense. And if you take the analogy of you put a metal ball, you take two metal balls and you put one of them on a track that has a steady 5% decline on the track. It's just a flat 5% decline on the track. And you take another ball that has an equally as long track in linear distance, but that track has an up and down. It has peaks and valleys, highs and lows along the way. And the start and the end have the same overall decline that the one that has a steady 5% decline has. And you let both balls go at the same time. The one with the steady decline for the first half or so is going to be out in the lead. And you're going to have this other one that drops down and then up and then down and then up and then down and then up. And it's going to start picking up momentum. And it's the one that has those ups and downs along the way that ends up winning in the long run. And what I get by that is what I mean by that is you've got to be a little bit risk averse. You've got to take some risk in order to experience the ultimate financial goals that you want to experience. And if you take no risk, well, you're giving up first inflation, oftentimes tax inefficiencies, and fees that are going to come in the form of your financial advisor or the mutual funds that you invest in. And net, maybe you grow your portfolio by 3 or 4% at best over a 30-year period. And so kind of walk us through then the other side of the table and what does the real estate side of the table look like, and how do you really protect, I guess, from risk on that side?
So, and we talked to some investors also that have invested with operators that have, I'm doing air quotes, not experienced losses in the past couple of years. And one of the ways that you can do that as a real estate investor is thinking about how you're deploying leverage. So when you purchase real estate, typically you're going to put some equity down, you're going to work with a lender, and that lender is going to have certain provisions. You can get fixed rate notes, you can get variable rate notes. If you get a variable note, you can deploy rate caps on that, right? So you can ensure that if there are going to be increases in rates moving forward, you can protect against that. So you're essentially transferring risk of that rate cap increase from you to the bank, no different than the annuity investor transferring that risk of a market downturn from yourself to the insurance provider or the annuity provider. So that's one certain way to do that. Ty, as you know, if you do that, it's not free. There's going to be a cost involved if you deploy a strategy that ensures 100% of the time you're never going to have a fluctuation in your interest rate expense as it relates to your overall pro forma and your cash flow ability out of the fund.
Yeah, and we've done both. We've purchased rate caps on, and typically, what for listeners, you mentioned fixed rate loans and variable rate loans, and I've had our investors ask, well, why did you get a variable rate loan? Well, a property that has a value add aspect to it, where you are going to manipulate occupancy in order to renovate and implement CapEx to ultimately increase overall rent on a per unit basis, you're not going to qualify for long-term fixed rate debt. You're going to have to get bridge debt, and bridge debt comes with the downside is its variable rate. And so we've played both sides. We've done rate caps, we've done non-rate caps. We had a rate cap that ended up paying us let's see, 18, 19x the value of the rate cap that we purchased. Purchased rate cap for $250,000. And I'm sorry, $125,000. And it paid us north of $2 million. We've also had a scenario where we paid a little over $1 million for a rate cap that didn't pay much of anything. We've had assets that we didn't get a rate cap on, and it chewed up every bit of the cash flow. And so, I think what we're looking at now with our newest fund, well, number one, we're the beneficiary of having access to capital. So secondly, it gives us opportunity. And so the opportunities that we're looking at are lenders that have put so much pressure on a borrower that doesn't have access to capital, and now borrowers willing to walk away, or borrowers willing to negotiate and have some sort of earnout built into a sell strategy. And so now our negotiation becomes with the lender. Lender has $20 million loan, they're willing to take a $15 million DPO. Well, we're getting $5 million of equity day one. And so, now with that strategy, I'm looking at using far less leverage and using more cash, which is another way to reduce risk on the front end. When you're acquiring assets at, 65, 70, 75 cents on the dollar, and then only getting 50% leverage on that, you're ultimately at 35 to 40% leverage on the value of the asset in totality. And so you've got far less risk. Now, what does that come with? Less return. That's part of that ebb and flow there. So as we look at that, let's look at the other side of the table now, the investors who are willing to accept risk. Why do you believe that that side wins 80% of the time in shorter windows and basically always wins over a 10-year plus or minus playing field?
Great question, and you're right. Time is the great equalizer as it relates to these investments, and so I think probably the best way to drive that home is let's talk specifically about an equity market investor in 2000. So if I was an equity market investor in 2000 and I had $100 invested in my account, everyone remembers the big dot-com bubble that happened. They saw their account shrink to about $53, $54 by the end of the year.
Oof.
A lot of investors at that point just pulled out of the market. They had enough volatility and I don't want to experience any further losses. And so they essentially locked in close to a 50% loss. Those who just stayed the course, meaning they experienced that loss, but they kept money in. Now, it took several years for them to get back to even. But if they just stayed the course and stayed in the market this year in 2026, as of about 2 weeks ago, their account would be worth $813. So, what about those that were in a variable annuity during the exact same time period? So, if they invested that money in a variable annuity, so never experienced a quote unquote loss because there was a high watermark provision, that same investor would have $592 in their account. And that's purely a factor of the higher fees that they paid for that privilege. So, we're talking a 25-year period, 20, almost 26-year period. The investor, to your point earlier, that experienced that volatility along the way, but didn't pay those higher fees, has significantly more wealth at the end than the investor that paid those higher fees to reduce that volatility and ultimately ended up having less in wealth available. So, the real key message here that I want to make sure our listeners understand is time, again, time is the great equalizer. If you have 5+ years, you're typically always going to do better if you're an investor on that right side of the table, at least 80% of the time.
I think you make a good point, and I've been in business long enough. I've taken risk. Um, the thing that I have, one of the things that I have going for me is I'm one of those people that I get kicked and kicked and kicked, and I'm going to continue to get up. And so you can continue to take those risks. I've experienced this with my own physical health, to the point that I've experienced, I mean, I've had 6 knee surgeries, 2 collapsed lungs, you name it. It doesn't matter. And I keep coming back. But the same thing holds true with business. And, Trump talks about this all the time. And you see it kind of all the time. The difference between a successful person and an unsuccessful person is the unsuccessful person gave up after 3 attempts, and the successful person continued on until his 10th attempt, and that 10th attempt paid off tenfold for every attempt prior to that. And you you can't I don't think you can ever accomplish financially in life your max potential if you don't take risks. And I've been fortunate enough to have nothing. And many people who've followed me, know my pizza story that I talk about. I'm not going to share that today, but have heard my pizza story. And I've been fortunate enough to have 10 figures in a bank account. And, you know, I'm sorry, not 10, eight figures. I've had 8 figures in a bank account. And so you look at what it took to get there. And along the way, I've had business dealings where I've lost north of 7 figures from one reason or another. But I didn't have that by not taking a risk to get to having enough money to lose that much money. So I would rather be the person that has the ability to lose 7 figures and come back and build that to 8 figures than the person who doesn't ever take any chances along the way, and they don't necessarily ever meet their financial goals. And so it goes back to take the shot. Like just take the shot. And then when you take the first shot, take the next shot. And Brian, I know you've experienced that. We've had a number of conversations around, different clients that you've had or talked to, and experiences they've had. But, you know, really you give a really powerful example, um, with especially with the four types of investors. But the investor who stayed invested through the early 2000 drawdown or the dot-com bust, that investor ended with far more. I think it was just over 8x, 8.5x, you said, far more than the never lost money annuity investor who, I didn't lose any money and I took the nice slow route. So walk us through the lesson. Why does avoiding losses sometime lock you into a lower overall outcome?
Yeah, it seems kind of counterintuitive because you would think if I am avoiding losses, I'm going to have a bigger nest egg at the end. It all goes into fees. Look, the banks that are selling rate caps, they want to turn your losses into their gain. Operators that are advertising, we've never experienced a loss, they want to turn your loss into their gain. The big public REITs that are saying we don't have losses, they want to turn your losses into their gain. If you have at least 5, preferably 10 years before you're going to need complete liquidity, and when I say complete liquidity, just for the portion of your investment that's in real estate, this is not your entire portfolio, but for just that slice of investment that's in real estate.
So take a person that's worth $3 million and they allocate 750,000 to real estate. In essence, they still have $2.25 million that can be accessed depending on where the equities market is at any given time. So you're saying have a mindset that $750,000 is locked up for 5 to 10 years, right?
Correct.
Okay. Okay.
That's right. And if you have that mindset, you are going to build far greater wealth with an operator that does exactly what you described earlier, Ty, and that is they're going to deploy, I'll say, a mix of fixed rate loans. They're going to look at rate caps where it makes sense, but they're going to use a strategic blend of loan provisions that ultimately are going to create a better outcome for their investors and not strictly look at the quote unquote safe route. I think back to your point earlier, something that I think a lot of people have heard about, maybe not everyone, is this term illiquidity premium. And there is a
Illiquidity what?
premium,
Yeah, illiquidity
illiquidity
premium.
premium.
Okay.
And so when you think about real estate specifically, yeah, we do hear that. Well, I don't want to not have access to this money for a period of 3, 4, 5, 6 years, whatever it may end up being. And the question I always ask is, well, is that for your entire portfolio? Because to your point earlier, rarely is this 100% of their investment. It might just be for a portion of it. So you might as well get paid a premium on that portion of your portfolio that you may not need access to for the next 5 or so years.
Well, okay, and then you bring up access too. And we've got investors that are in their late 80s that have locked up capital for an extended period of time. And I still get the occasional investor that's, he's 70 years old. Well, I just don't know if I want to commit my capital for another 5 years because, I may not be here then. What are you going to do? Take it with you? Like it's not, yes, let's say you're investing, let's say you got a $3 million net worth, you're investing $500,000 into real estate. Okay, fantastic. So the $500,000 is locked up, and the stronger amount of gains on that investment is not recognized until the end of, call it 5, 7 years, whatever it is. And so, you're going to invest that $500,000. The operator is going to execute the value add, the business strategy, and the asset or your investment is going to go up in value, to $800,000 over a 5 year period. Okay, that's kind of on the lower end, but let's say it's 800,000. along the way, you're going to experience some time where there's cash flow on that deal. You're going to probably experience some time where there's not any cash flow on that deal. But regardless, that cash flow is going to create you some liquidity as well. And so when you're looking at locking up that capital, like you said, it's a portion of your overall net worth. That portion that's locked up, if for some reason for an 88-year-old investor that passes away before it becomes liquid, it still passes down to in the form of their trust or their will to their beneficiaries, or however, if they want to donate it, however it's going to pass down, whether it's cash or an investment, it doesn't change. And so, what is that liquidity factor that a person's looking for? Now, if you take an individual who is nearing retirement and they need that liquidity for some reason, okay, that's a whole different story. Now let's, discuss that. But at the end of the day, liquidity is a factor around this, and the illiquidity, to your point, gives a multiplying effect. And you look at it and you say, okay, well, how much can this $500,000 generate me in the form of cash flow in a strong market and strong investment opportunities? Maybe it's generating 6, 8, maybe 10% in cash flow. Then in a down real estate market, maybe the property is putting all of its capital back into and all of its cash flow back into the asset. Okay, so net over the life of that 5 or 7 year investment, you see an average of 3% cash flow at a given time. But then you also have the 1.8x multiple on the investment when you exit the investment at the end. And I think that's where you're really looking for the overall premium that you're going to get for locking up that capital. So, why, flipping back a little bit, why do annuity sales spike after every market correction? And what ultimately does that reveal about individual behavioral finance? How how does a normal investor react when we see that spike, and then how do investors protect themselves from making fear-based decisions? Because that's what I think we see most of the time in the equities market and even in real estate. We've got, 10% of our investors, when we stopped doing distributions on some of our properties, 10% of our investors were worried because the investment was, quote, no longer performing. That's not necessarily the case. And they start making fear-based decisions with their capital. So how does an investor change from making fear-based decisions to making more analytical-based decisions?
Yeah, I mean, for most investors, actually for any decision, not just financial decisions, the fear of losing is often a more powerful motivator than the excitement of winning. And you could tie that into sports. You could make a number of different analogies around that, but it especially applies in finance and in building your wealth and in investing. And so the reason annuity sales go up when you have volatility, especially when you have a downturn, is the same reason why people do just the opposite. And that is when they see the market going up, they get excited and they tend to buy. I just talked to an investor today that was excited about buying into gold. You realize how much gold has gone up in the past couple of years? I mean, they are
Yeah.
buying at the very high point when
Well, and
they
it's
should
funny.
have, in retrospect, done it 3 or 4 years ago.
It's
But
funny if you turn
that's
on Fox News, Newsmax, any of them right now, all of the advertisements are about gold. Have you seen what gold has done in the last 3 years? Buy now, buy now, buy now. And they're using that fear-based tactic. Hey, gold has gone up so much in the last 5 years. Buy now, buy now. You're buying at the top of the market.
you're buying at the top of the market. And the same thing applies on the inverse. When the market starts going down, people get scared and they decide I better take some chips off the table now before I lose any more. Well, the reality is you've already lost some, right? So mentally you're doing just the opposite, as we've talked about on earlier episodes, doing the exact opposite of what you should be doing. You should be selling here and buying here, not the opposite. And so that's one of the reasons, to your question earlier, why annuity sales go through the roof. We hear the same thing. You hear a lot of advisors that focus on specific types of products. I hear a lot of them focusing on annuity sales, and you're going to see that really pick up now. And that's specifically to address that fear, that behavioral bias of I don't want to lose, and I see this volatility, and I want to make sure that I lock in, quote unquote, lock in some of the gains that I've made in the market. Do you know how many annuity sales are made to your typical 25, 35, or 40-year-old investor? It's another good analogy, Ty. Think of it this way. If you're 25 years old and really healthy, should you buy life insurance? And I guess the answer to that is, well, if you need it, if you get hit by a bus tomorrow, sure, you should buy life insurance. But the chances are, statistically, you're not going to need it. And you've just spent whatever that premium dollar was, you've gifted that to the insurance company to take a very, very, very low risk that they're ever going to have to pay out that. It follows the same kind of behavioral synaptics as annuity sales when you see the market start to do corrections like we've seen recently.
So with that, maybe bring us home a little bit for real estate. So if you talk to 10 potential investors, the likelihood over the last 3 years that at least one, if not up to three of them, have experienced a loss in the last year, 2 years, or 3 years. So if someone's in that experience, they've experienced a loss in the last couple of years, and now they want no losses, or they're asking operators, and I've had this question, well, why didn't you buy a rate cap on everything? Or why didn't you not use debt? Or why didn't you not get a bridge loan? And, specifically on the types of loans, that goes back to the type of asset. So what would you say to that investor? And what's the smartest mindset that they can have for the next 10 years?
Yeah, I think the overriding theme I would say is look, the biggest threat to your future wealth is myopia. And if you've got at least 5 years, ask yourself, if you've got at least 5 years before you need liquidity for that specific portion of your portfolio that's invested in real estate, if you have at least 5 years, then having a few losses along the way is actually better for building your long-term wealth than if you had no losses in the past couple of years. And that's going to seem very counterintuitive. But based on everything that we talked about, what that means is you are working with an operator that deploys a multitude of strategies, and ultimately you're going to build greater wealth with that over time than if you focus specifically with an operator who deploys rate caps exclusively, which, as you mentioned earlier, Ty, is also going to really limit the types of properties that you have access to investing in the first place.
So we're getting to the end of this episode, but I think you brought up a really good point there. When you talk about if you work with an operator who may experience a couple of losses along the way, it can be more beneficial to your overall portfolio. And you're absolutely right there. And we could have a whole nother episode about this alone. But if you take that example, let's say over a 10 deal, you invest into 10 different opportunities with a real estate operator. And in those 10 deals, two of them experience a loss. Well, those two, and that's over a 10-year period, those two are going to create a recognizable tax loss, tax write-off now, that can ultimately be utilized against capital gains on those other eight. And so now the overall return metrics on those other eight gets boosted. Plus, I go back to that analogy of the two balls racing, one on a flat down line and the other one on peaks and valleys, but the same equivalent down line. And you take 8 wins and 2 losses across somebody who doesn't ever take any losses. Those 8 wins, with the losses included, are still going to far outweigh any upside win that the person that took no losses is going to have. And then you add into that the impact, the tax impact of that, which boosts that even further. So we'll end it on that. I know we got into a number of different topics here. So maybe we need to talk about wins and losses on another episode. But that being said, overall, when you focus your investments on diversifying and specifically not diversifying within the same asset class, but also diversifying asset classes and then focusing on, what I refer to oftentimes as those four keys to success as it pertains to investments, where your investments are deriving two, three, or four of those at any given time. That's appreciation, equity, discount on the buy, cash flow, and tax advantages. You're going to be set up for more success. And you've got to take the shot. At the end of the day, take the shot. The person that takes 10 shots and misses some of them is going to far outpace the person who waits and waits and waits and waits and waits and takes one shot. And so take the shot again, and take the shot again. That being said, thanks for joining us on this 16th episode of The Growth Factor. Brian, thanks for all of your insight today. I think this one was really strong. So, if you have any questions or comments on anything that we've talked about, please feel free to comment in the comment section or reach out to us. We can be reached at lasatercapital.com. That's LASATERCAPITAL.com. And you can actually jump on there and register for a call with Brian, myself, or Boone, my business partner. Look forward to hearing from you. Again, if you have any questions or comments, please comment below, whether you're watching this on YouTube, X, Facebook, Instagram, whatever it is. Definitely comment below. Look forward to hearing from you.